What's happening, everybody? It's your boy Kreative. Go ahead, sit with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We're going to be talking about MACD. So, we're going to be dropping another episode in our KreativeU series talking about an indicator most of y'all have heard of, right? Which is MACD. And we want to understand what does MACD compose of, how to be able to use it properly when it comes to your algos, right? And how can we calculate it ourselves, right? And we're also going to be creating a strategy using MACD. So I'm super excited for this work we have planned for y'all today. So if you haven't already, go ahead and smash that like and subscribe button. So let's go ahead and jump in. So let's go ahead and go to our first lesson. Our first lesson is understanding what is MACD. So MACD is the moving average convergence divergence, right? So convergence, how close is it to coming together? Divergence, how close is it to be able to go apart, right? So moving average, the average cost of the particular asset that we're looking at, right? So moving average convergence divergence. It shows when the fast and slow momentums meet or separate. So EMA is going to be the exponential moving average. This is recent prices count more than the older ones, right? So, and then we have momentum is going to be speed of the price movement. This is like a fast car, like how fast a car is going, not where it is. Convergence is coming together, two lines getting closer like friends meeting. Divergence is moving apart, the lines separating like friends going their separate ways. So definition, MACD stands for the moving average convergence divergence. It was created by Gerald Appel in late 1970s. MACD shows the relationship between two moving averages of the prices. When they come together, they converge, or move apart, they diverge. It tells us something about momentum, the speed of the price movement. So memory trick, MACD equals two runners racing. When the fast one pulls ahead, momentum is strong. And when they're close together, momentum is weak or changing, right? So MACD lines equals the 12 period EMA, which is the 26 period EMA. Signal line is going to be the 9 period EMA of the MACD line. And then the histogram equals MACD line, subtract the signal line. So we're going to be breaking this down so we can actually understand it. So why 12, 26, or 9? These numbers come from the trading weeks month. So 12 is roughly 2 weeks of trading days. Roughly 2 weeks of trading days. 26 is roughly 1 month of trading days, and 9 standard smoothing period for the signal line. I feel like that's super loud. Hold on. I'm sorry. There we go. My fault. So Jared Appel chose these based on his research, and they work well for most markets and time frames. So what MACD tells you? MACD tells us the trend direction, right? MACD above 0 equals bullish. We think that the market is going to go up, right? A MACD, it tells us the trend strength. The bigger the histogram equals a stronger momentum. Positive potential reversals, the crossover signal changes, that is going from bullish to bearish or from bearish to bullish. Or divergence, when the price and the MACD disagrees. So let's take a live look at MACD data from the S&P 500. S&P 500 is the top 500 companies within the New York Stock Exchange. So looking at the date of this last Friday, the close was 681.75. The MACD line was negative 0.2612. The signal line was plus 92.72. The histogram was negative 0.1884. This is, we have a trend bearish, and the momentum is doing what? It's decreasing. So we thinking the market is going to go down, and the momentum is agreeing with that. So let's go ahead and jump into our quiz. So what does MACD stand for? Is it moving average convergence divergence? I think I've heard that before. Is it multiple averages calculation data? That's interesting. Is it market analysis chart display? Interesting. Let's go ahead and go with the right answer. The standard MACD uses which periods? The standard MACD uses which period? Is it 5, 10, 3? Is it 12, 26, 9? I think I heard that before. Or is it 50, 20, 50, or 10? All right. And what does the histogram show? The stock price? Or is it going to be the difference between the MACD line and the signal line? I think I heard that before. Or is it going to be the trading volume? All right. Beautiful. So let's go ahead and jump into our next lesson. The Tre Amigos, to be able to really get into the weeds of MACD, right? So we have the MACD line, which is going to be the fast runner. It is calculated at 12 periods EMA or 26 period EMA, right? So the period is just letting you know how many minutes are passing. So 12 periods or 12 minutes, or 26 periods is 26 minutes, right? So we're taking 12 EMA minus the 26 EMA. And then the signal line is going to be the slow runner. This is the 9 period EMA, or 9 minutes of EMA, exponential moving average of the MACD line. The histogram is going to be the gap between the runners, shown as bars. The bigger the bar equals the bigger the lead. The zero line is the starting line. Above it is bullish territory, and we think that the market is going to go up. Below it is bearish territory, and we're thinking that the market is going to do what? Go ahead and go down. Fast EMA is at 12 periods or 12 minutes, reacts quickly to recent price changes. Or we have slow EMA, which is 26 periods or 26 minutes of EMA, reacts super slowly and smooths out the noise. So the three amigos of MACD, right? MACD has three components that work together like a team. Each one tells you something different about the momentum. Amigo 1 is going to be the MACD line. This is going to be the fast runner. The formula is going to be 12 period EMA or 12 minutes of EMA, subtract 26 minutes of EMA. So think of it as the fast runner in a race. It reacts quickly to the price changes. When positive, fast EMA is above the slow EMA. This is bullish. We're thinking that the market is going to go down. When it is negative, the fast EMA is below the slow EMA, and it is bearish. We're thinking that the market is going to go down. So the analogy is like a sports car, fast and responsive. Amigo 2 is going to be the signal line. This is the slow runner. So formula, we're using 9 minutes, again, periods. You're going to just replace that with minutes. 9 minutes of EMA of the MACD line. So think of it as the slow runner chasing the fast one. It smooths out, the MACD line. The crossover with the MACD line equals trading signals, acts as a trigger for buy-sell decisions. And this is how we're going to be creating our strategy that we're actually going to be backtesting here live with y'all, but more on that in a little bit. So analogy, it's like a delivery truck, steady and reliable. And then we have Amigo 3, which is the histogram, the gap between the runners. So MACD line, subtract the signal line, that gap is going to create a histogram. The bigger the histogram is how much momentum it's going to have. So think of the distance between the two runners. The positive bar, MACD, is above the signal. The fast runner is ahead. That's where we're in a little bit of a bullish territory. We're thinking that the market is going to go down. The negative bar, MACD line, is below the signal line. The slow runner is ahead. It just flipped. Now we're in a bearish territory. We're thinking that the market is going to go down. Taller bars, bigger gaps equals stronger momentum. Smaller gaps equals weakening momentum. So think of it like this. The gap is in a race, shows who's winning. So the zero line is the starting line. The zero line is like the starting line of the race. MACD above zero, the fast EMA is greater than the slow EMA. Then we are bullish. We're thinking that the market is going to go up. But if the MACD is below zero, the fast EMA is less than the slow EMA, we are bearish. We're thinking that the market is going to do what? Go ahead and go down. So here's a live breakdown of being able to see the calculation step by step. So step one, we're going to take 12 minutes of the exponential moving average, and we're able to get, that's going to be 687.91. Then we're going to take 26 minutes of the exponential moving average. That's 688.18. So step three is going to be our MACD line, which is taking the 12 minus the 26. Now we have negative 0.26. Remember, if we're negative, what are we? Bearish, right? So this is letting us know that we're on a bit of a bearish decline. Yeah. So MACD values for the last 10 days. So MACD has went bullish, a little bit of bearish, just recently, this past Friday, right? So when we see the bar, right, the bar is just letting us know strong momentum did happen here, and then it weakened out a bit, and then we have strong momentum carrying back on. So let's go ahead and jump into our quiz. So what is the signal line? The signal line is the 12 period or 12 minutes of EMA minus the 26 minutes of EMA. That sounds familiar. Or is it the 9 periods of EMA of the MACD line? Or is it the stock closing price? So let's go ahead and jump back up just to make sure we get this right. Signal line is what? 9 minutes of EMA of the MACD line. Beautiful, bruh. When the histogram shows tall positive bars, what does it mean, right? Remember, the histogram is the gap between the two runners. The wider the gap, that lets us know who is running and how tall that momentum is, right? So if we have a tall positive bar, we're number one, tall, strong momentum. Positive, bullish, right? So strong bullish momentum, right? So we have strong bullish momentum. Beautiful. So MACD is above the 0 line. What does it indicate? So MACD is above the 0 line. So the 12 EMA is above the 26 EMA. Below. The 12 EMA is above the 26 EMA. That is bullish. It's above. That makes sense. Or the stock is overpriced. I wouldn't be mad if you said that, but just kind of laugh. All right, so let's jump into our next lesson. Our next lesson is going to be the crossover, when the runners pass each other. So MACD line crossover above the signal line. This is a potential buy signal. This is our bullish crossover. Our bearish crossover is when the MACD line crosses below the signal line. This is a potential sell signal. So the golden cross is when the fast line crosses above the slow line. The bulls are winning. The not so golden cross, I'm not going to say that word. The not so golden cross is when the fast line crosses below the slow line. The bears are winning, right? So confirmation, we're going to wait for extra proof before trading. Don't just jump the gun. So a crossover happens when the MACD line crosses the signal line. So think of it as one runner passing another in a race. So a bullish crossover, which ideally can be our buy signals. We can have a buy signal with a bearish crossover too, but it's all depending on your particular strategy, right? And you're going to see once we actually get into our strat. So what happens is that the MACD line crosses above the signal line. Analogy, the fast runner passes the slow runner. Signal going uphill, momentum is increasing. What it means is that short-term momentum is turning positive, potential start of an upward trend. Many traders see this as a buy signal. Histogram goes from negative to positive. Went from negative to positive. All right. And then we have our bearish crossover, our sell signal. What happens here is the MACD line crosses below the signal line. Analogy is that the fast runner gets tired. Bruv, I've been running all day. And the slow runner's like, I just needed that. I just needed that little bit of motivation. And it catches up and passes. Momentum is fading. So what this means is that short-term momentum is turning negative. The potential start of a downward trend, meaning traders see this as a sell signal. Histogram goes from positive to negative. So 0 line crossover is a bigger deal. When MACD crosses the 0 line, it is a bigger signal. So MACD crosses above the 0 line, major bullish shift. So 12 EMA just crosses above the 26 EMA. So 12 minutes of EMA just crossed over 26 minutes of EMA, right? So the MACD crosses below is a major bearish shift. So we think that the market is going to go up. We're thinking that the market is going to go down. And when this happens is that the 12 EMA just crossed below the 26 EMA. Pro tip here is that zero line crossovers are less frequent, but more significant than regular crossovers. Excuse me. So some recent crossovers that happened back on the 15th of January, we had a bearish one. The 28th of January, we had a bullish one. The 30th, we had a bearish. On the 2nd of this month, we had a bullish. And on the 3rd, we had a bearish. So the current MACD status is bearish, right? The market is decreasing, bit of a downward trend. Let's go ahead and jump into our quiz. A bullish crosses over occurs when the MACD line crosses below the signal line. That sounds more bearish to me. Maybe. The MACD line crosses above the signal line, or the price hits a new high, crashes through resistance. So we are going to go with B here. When the histogram changes from negative to positive, right, it indicates what? That the bearish crossover just happened. Maybe if it went from positive to negative, the bullish crossover just happened. That's a little bit more, right? Because it went from negative to positive. Nothing significant. I would say you weren't listening. So MACD crossing above the zero line. This is a little bit more significant, right? So MACD crossing above the zero line, 12 EMA just crossed above the 26 EMA. Major bullish indicator, right? The stock just turned cross zero. Time to panic. I don't know. Or depending on your position. All right, let's go ahead going over lesson 4, which is reading the histogram, the momentum fuel gauge. So the histogram is a visual bar showing the distance between the MACD line and the signal line. So the growing bar is a bar that gets taller, momentum is increasing, and the trend is strengthening, right? A shrinking bar is a bar getting shorter, momentum is fading, and trend is weakening. A positive histogram is a bars above zero. MACD line is above the signal line. We're in a bullish territory. Negative histogram bar, the bar below zero. MACD line is below the signal line. We are in bearish territory. So the histogram is like the fuel gauge for your momentum. It shows how much gas is left in the current move. Reading positive histogram bars, right? So this is the green bar. The growing bar is a bullish momentum is increasing. MACD is further ahead of the signal and the trend is getting stronger. Good to hold or add long positions. A shrinking bar, bullish momentum is weakening. MACD is slowing down. The signal is catching up and the trend is losing steam. Warning, bearish crossover may be coming. And then reading the histogram bar, a growing bar, bearish momentum is increasing. MACD is falling further below the signal. Downward trend is getting stronger. Good time to hold short positions. Shrinking bar, bearish momentum is weakening. MACD is recovering, moving back towards the signal. And then the downward trend is losing steam. Warning is bullish crossover may be coming. So here's a histogram cheat sheet, right? So if you have the bars that are in this pattern here, bulls are gaining strength. These are time to buy. If you have bars that are in this pattern here, bulls are losing strength. This is time for you to be cautious. This pattern here, we have bears are gaining strength. Time to sell or short our position. We have this pattern. Then we have the bears are losing steam. Time to be cautious. And then we have from red to green, a crossover, a trend change is happening. So live look at the last 20 days of the S&P 500. We're seeing that we are in a bit of a bearish histogram, right? Strong trends that's been happening these past few weeks of these last 20 days, right? And we haven't seen that crossover just yet. We are in strong bearish. Histogram bars are growing negative. So a growing positive histogram bar indicates what? So a growing positive is bullish histogram bar. So bullish momentum is increasing. So growing bullish momentum is increasing. So we're going to be B. When the positive histogram bar starts shrinking, it's a warning that, so positive is bullish, histogram is letting us know how that momentum is. It starts shrinking. So bullish momentum is shrinking, right? So bullish crossover is coming, momentum is strong, bearish crossover may be coming, right? So positive histogram bar is shrinking, bearish crossover may be coming. Histogram shows us what? The stock price. The distance between MACD and then the signal line, or the trading volume. So it is going to be the distance between MACD and the signal. So divergence. When the score lies, right? A bullish divergence is when the price makes lower lows, but MACD makes higher lows, reversal coming up. A bearish divergence is when the price makes higher highs, but MACD makes lower highs, reversal coming down. Higher divergence is a trend continuation signal, less common but powerful, excuse me. A regular divergence is trend reversal signal. The scoreboard is lying. And then confirmation is we're going to wait for the price to actually reverse before trading divergence. MACD divergence is the scoreboard is lying. So divergence happens when the price and MACD disagrees. It's like the scoreboard showing you who's winning, but you can actually see your team is getting tired and slowing down. A bullish divergence, reversal upcoming. So the price makes lower lows, right? Boom, it just made lower lows. Boom, just made that lower low. And MACD is making higher lows, right? What it means is that the price is falling, but momentum is not. Sellers are getting exhausted. Reversal is the upside likely coming. So analogy, the score keeps going down, but your team is actually getting better. The comeback is incoming, right? If we're seeing this bullish divergence, is that, all right, the bulls are starting to come back, right? So we're making higher lows and then lower lows what the price was making. A bearish divergence is a reversal downcoming. What we'll see is that the price is making higher highs. MACD is making lower highs. What it means is that price is rising, but momentum is not. Buyers are getting exhausted, and reversal to the downside is likely coming. The score keeps going up, but your team is getting tired. The trouble is ahead. So important divergence rules is divergence is a warning, not a guarantee. We have to wait for the price confirmation before we start trading. Works best at extremes. Look for divergence at major highs/lows. Multiple time frame confirmations. Divergence on daily and hourly equals stronger signals. Don't fight the strong trends, right? Divergence can persist in strong trends. So let's go ahead and jump into our quiz. So bullish divergence happens when the price makes higher highs and then MACD makes lower highs. Or is when the price makes lower lows but MACD makes higher lows. Or is it when both no. So is it B, bruh? What should you do when you spot a divergence? Immediately trade in the expected direction? Probably not. Wait for the price confirmation before trading. That sounds familiar. Ignore it. Divergence don't work, right? If you wait for a confirmation and you see it, then you can actually say, okay, you know what? We found something. A bearish divergence at a major price high suggests the price will keep going higher. Buyers are getting exhausted, and then potential reversal down, or is a strong bullish momentum. So it is buyers are exhausted and potential reversal down. So what we're going to do now is let's go ahead and go jump into our back test that we're going to be using, MACD, right? So now we understand how MACD works, right? Now we understand what it is and how to be able to use it. Now we're going to actually create a strategy using MACD, right, in order to do this, right? So this is our MACD baby back test. It's going to be trading 0DTE SPY options for a MACD scalper strategy. So 0DTE are going to be option contracts that expire the same day. SPY is going to be the S&P 500, the top 500 companies within the New York Stock Exchange. And an option gives us the right but not the obligation in order to buy the stock. And that underlying stock is going to be SPY, right? We're using MACD, and we just talked about what MACD is, right? And this is going to be our scalper strategy. Scalper is letting you know we're going to be fast in and then fast out. So strategy overview is we're going to be using ultra fast MACD crossover strategy for 0DTE SPY options. Uses a compressed 5-3 MACD configuration optimized for rapid signal generation, allowing for entries as early as 9:38 a.m. right? Core concept is that the MACD, which is the moving average convergence divergence, measures the momentum by comparing the two EMAs. When the fast EMA crosses the slow EMA, this signal is a momentum shift. For 0DTE scalping, we use the ultra short periods to catch quick reversals. So MACD components, we're using the fast EMA, we're using 3, ultra responsive for price changes. And then our slow EMA, we're using 5, which is the quick trend reference. And then our signal line is going to be 3, EMA of MACD. And then our histogram is going to be MACD subtract the signal. And this is the momentum visualization. So standard MACD, remember, is 12.26.9. But for our scalper, we're going 3.5.3. So the first signal is going to be 8 minutes in. So that's why the strategy starts trading at 9:38. So for a bullish signal, this is what's going to happen. Or for when we want to buy a call, right? And that's our bullish signal. We think that the market is going to go up. The MACD line crosses above the signal line. This is a bullish momentum shift. Expect the price to rise. And we're going to buy a put because we're bi-directional here, is when the MACD line crosses below the signal line, the bearish momentum shift, expect the price to fall. So a visual representation, right? The MACD line, the signal line is above it, right? Cross above, we're going to buy a call. MACD line, signal line is below it. Boom, we're going to buy a put. So this is our entry rules. We're only going to be entering between 9:38 and 11:28. Only one trade per day. MACD is, a MACD crossover is detected. Either it's going to be bullish or bearish. And then we're going to find a valid option for delta and premium. And this is how we're going to exit. This is a little bit of a mean reversion strat, right? So the multiple take profits is going to be, first take profit level is going to be at 12%. Second take profit at 10%. And then 8 is going to be our 3%. I'm giving the strategy multiple ways to exit, right? And then our stop loss is going to be at any one point in time, the option is down 10%. Get us out of the strategy. Don't hope and dream. And then our trailing stop is that whenever we're up 3%, we're going to trail 1.5% behind it so we can lock in some type of profit. So this is going to be our option selection. We're going to be using a delta range between 0.05 and 0.58, wide range for flexibility. Now I may increase this a little bit, and I may like do 2 or 3 revisions with y'all just to be able to see how we can improve this. But nonetheless, let's keep going. And this is how we're going to score it. 60% gamma efficiency, because gamma puts a turbo boost into delta, right? So gamma efficiency is gamma bias over the mid price, bang for your buck. I don't know why we're using mid. It should be bid here, so we're going to update that. So that's one thing I just noticed. So gamma calculation using Black-Scholes, and then we have the position sizing using VIX, and VIX is the fear gauge, the volatility index. It allows us to be able to gauge how volatile the market is going to swing, right? So if we have less than $499, we're going to use 88%, and it's also going to be scaled by VIX. So we can see that here, our realistic pricing, and then our data sources. So this is, of course, only educational content, not financial advice. Trading involves what? Substantial risk. You are solely responsible for your trading decisions. So this is the backtest file, right? So I went over on how it looks. So this is the actual file if you want to take a look at it. One thing I just noticed is that this whole mid-price game, like, why is it using mid-price? I just seen it. Just showed it. There it is. We should be using bid. I'm asking, excuse me, because we're getting into the market, not getting out, but I'm going to go fix that before we run this. So here's the actual back test. And unless I tell you otherwise, all of our back tests are going to start at $100 because we want to be able to dispel the notion that you need thousands of dollars in order to trade options. So we're starting at $100. And I want to see if we gave the strategy $100, how well does it perform? So what is a back test? A back test is when you take your strategy, drop it off in a time machine, and you want to see how well it performs on past data. Now, the school of thought is that if it does well in the past, there is a likelihood, no guarantees, because there's no guarantees in trading, but there's a likelihood that the strategy will do well in the future. So that's why when it comes to creating any strategy, right, we have this particular process here. So we have our strategy idea. The strategy idea came from the MACD lesson that we just went over. Now we're going to back test it. Now I don't know if I'm going to make it a bot yet because I kind of already have other bots that we are using. Let me just zoom this out. My fault. So we are in the strategy ideation and being able to back test it. So this is where we are. So this is my process when it comes to being able to create or do before even like creating a bot, because this is like what you want to do last. Like you don't want to go straight to making a bot. That's how you get wrecked, fam. Like you want to test your strategy. So that's what we're doing here. Right, we talked about the signals. We talked about being able to do this. I think I'm going to increase do that, but one thing I want to look at is why am I using the mid price? All right, so that's one thing I need to make note of. So what I want to do is just, okay, let me copy this. Let's run our back test so we can actually see it running, fam. Let's go ahead and run our back test. And we're going to be running our back test on 2024. So it's pulling in all of the data. And again, this is our MACD scalper back test. We're running it on 2024. This is the PARMs that is running. Just one thing I just kind of got to keep in mind is we need to change that whole mid fam. So let me just bring in Kodr real quick. So while that's running, don't worry, I'm going to come back to it. Let me bring in Kodr real quick. Let's go back to this. So, all right, let's talk about the back test. So the back test was able to go from $100, start at $100, then it went to $12,815.21. So the total profits, right, was almost all 12,000%. Max drawdown is at one point in time the strategy was down $1,200, but it felt so bad it was able to rally to 12,000. So drawdown percent is under 10%, so that's not that bad. Sharp ratio is 7.73, right? That is freaking phenomenal. This is hedge fund levels. Hedge funds are looking for sharp ratio that is above 2. So the fact that we're at 7.73 is kind of crazy, fam. Total trades was 251. Out of those 251 trades, we were able to get 194 trades that were successful and 57 trades that were not. So we have a 77% win rate. Our profit factor is 3.59. Now, what I want you to notice about this is that the strategy felt so bad is that for every time it lost $1, it made $3.59 back. Our win-loss ratio is 1.06. Our average winner was $90. Our average loser was 85. Average trade was 50 bucks. So you can see it wasn't crazy, fam. Maximum consecutive wins was 15. Maximum consecutive losses were 3. ROI percentage, average ROI was 7.1%. Maximum ROI, we caught 51% at one point in time. And then we lost 29% at one time. Average hold time was 1.6 minutes. Maximum hold time is 2 minutes. So direction breakdown, just off call trades where we bet that the market was going to go up, we made 9,100. On put trades where we bet that the market was going to go down, we made 3,500. Exit reasons, and then days of the week. This is always interesting. On which days best day was Friday. Look at that. I mean, but for money, but if you're looking at when, was like Wednesday, Thursday was the best rate for 82%. So that's not bad. Time bucket analysis is that all of our trades happened from 9:38 to 10 a.m. right? 76%. We had no trades. We might as well just trade from 9:30 to 10 a.m. 9:38 a.m. to 10 a.m. So we found a sweet spot for this particular strategy. And it took this strategy 8 days, 8 trades or 10 days in order to get to 150, 32 days to get to 250, 46 days to get to 500, 66 days to get to 750, and under 100 days, trade 57, right, to get to $1,000. And then to 10,000, trade to 20, 317 days. That's not bad. Not bad at all. Not bad at all. So one thing that I just noticed that we do have to fix, I'm not going to hold you, is one thing, fam, because I noticed Sunny. I just want to make sure. Okay, beautiful. Y'all come back over here. All right. Review the following backtest. Can you advise where in the backtest is the bid or mid price being used? For the duration, let me also say you are a senior Python developer with expertise in 0DTE option strats. Review. Also have this little log for him. Then advise for the duration of the sprint, keep all of your responses under 228 total tokens for each output response. Now advise where the mid price is being used and if it is correct or not. So I'm using the Claude 4.6 model in order to go through and just audit this backtest that I made, because I noticed that I may have snuck in a mid price, and it should be using an axe price. So I just want to make sure that we're not over inflating our numbers here, that this is actually true, bruv, right? And once we are able to, yeah, I know that, bruv, thank you. Okay, so we are using mid. Okay, candidates, calculate the mid equals the bid. Okay, the mid price is not used for entry or exit pricing. That's correct. The entry price equals the axe. You pay the axe because we want to get into the market. The exit price, we pay the bid because we want to get out of the market. The mid price only is used as a denominator in the scoring formula to rank which option gives you the most gamma per dollar. This is a sound design. Using the mid for gamma efficiency is ranking the appropriately because you are comparing the relative value across candidates, not simulating executions. Okay, specifically, mid is used only where it belongs as a normalizing factor for option ranking. Okay, beautiful. So I'm not using it in that. All right. So we're able to do a couple things. One thing I want to do now is just tweak a couple of the parameters. So we saw we're able to go from 100 to 12,000. Bet. So let's see if we can improve that a bit. One thing I want to do is let me increase this delta min and go there. And then I also want to adjust. There's one thing I wanted to change. Let me just do the delta min. Let me just do the delta and just keep that where it's at. And that's the only thing I want to change right now. Yeah, that's the only thing I want to change. Bet. So let's see the impact of that. So I just made the delta min a little bit higher. So it's not like super deep out of the money contracts. Like we're being something that's a little bit more legitimate. Yeah. Not legitimate, just a little bit more easier to be able to make profits, right? So we're not getting eaten up by slippage. Remember, we talked about slippage before. If you want to check out our other video, and I'll drop that in the comments for you. But I'm running part 2 of our back test. I already ran 1. I just want to run 2 to see if we can improve it a bit just by improving the minimum delta, right? So let's see how much of an impact that'll have. And I'll run it one more time on 2023. I'll just spaz a little there. So I'll run it one more time on 2023 and see if that'll have an impact. Okay. Look at that. We did have an impact. So from 100 to 16,000. And the only thing I did, fam, was just increase the min delta, because I was like, yo, that's a little bit too deep in the money, or out of the money for me, excuse me. So we went from 77 to 81%. All right. Okay. Profit factor just increases a little. Okay. All right, let's go look at our, it's still taking us the same amount of time. Oh, less time now. That's what's up. Now that 10 o'clock hour is 100%. Okay. Now there's just one more thing I want to tweak. So I just adjusted the delta min to be 0.20. Okay, I'm Gucci with that. This premium min, I'm still thinking to be able to go up a little bit. Maybe let's do 0.88. So I just changed two things. I changed the premium min. Instead of taking a little bit more out of the money options and making it a little bit more deep out of the money, you can still take out of the money, but not as deep out of the money. And then I'm increasing the amount that you can buy for options. I'm seeing, yeah, yo, you're kind of making money. So let me just give you a little bit more access to capital. All right, so now let's go run it again. Copy the path. Python. So this is our third version. So let's see. So we went from 12,077%, 16,084%. So let's see what we can, if we can improve it here. Maybe, I don't know. So this would be interesting to see. Biggest thing that we're looking for is if we can get the risk profile a little bit down, increase the win rate, decrease the drawdown, and increase the profit factor as well. Maybe rough. Not as much. I think we're better at 80%. Yeah, I think we're better at where I was at before. I mean, it's still 16, but yeah, we were better where we're at before. We were better where we're at before. So you can just go back to 15. Or matter of fact, let me try this. 78. Let me try that. And then I'll go to 2023. All right, let's try that. So this is our fourth. I mean, I just want to see if being able to raise the minimum premium, because I don't want this strategy buying like junk options, right? So we wanted to raise the min premium a bit and to see if that'll impact the strategy and being able to make it perform a little bit better. Let's see. Let me look at the win rate. Okay, 4.24. Win rate is 82%. All right, I'm cooperative with this. Let's go run on 2023 now. So let's go see if we have consistency. Is it just 2023? Do I have to put year? I do have to put year. Okay. Year 2023. All right, bet we're running it on 2023. Now, let's see if we have consistency. First time running it on 2023. Let's see if we have consistency to be able to meet the same win rate and being able to keep the same metrics as far as drawdown is concerned. I mean, the total amount return, that's nice and all, but we're looking at the metrics, right? We're looking at the drawdown. We're looking at the Sharpe. We're looking at the profit factor. We're looking at being able to make sure that the win rate is respectable, being able to make sure okay, 82%, 5. We went from 100 to 14,000, so that's not bad. Okay, drawdown is a little bit less. Sharpe ratio is 9. Out of 250 trades, the strategy was able to win 205, so that's 82%. Profit factor is 5.03. This is 2023. Average winner was 84.94. Average loser was 76.94. I mean, this strategy is doing quite well, if I may say so myself. Only day that was losing is under 80% is Fridays now, but every day is comfortably over 72%, we can say. Now that's crazy. So y'all noticed before how that 10 to 10:30 was 100%. Now that bucket just dropped down from 10:30 to 11, and are still that first 38 minutes where like it's cheese there. Okay, strategy is still taking 8 days, 24, so it's not bad. So we are making strides, ladies and gentlemen. So I think this is a good stopping point. Maybe I'll make another video on being able to like really break down and continue to optimize this strategy. But the point was to be able to understand MACD and how to quickly and easily create a strategy with MACD and seeing how well it performs. So if you do have any questions, go ahead and drop it in the comments. It is your boy Kreative. I'll be back at it again with another episode.